If we go back to the previous slide, we can then start to allocate the cost items to the relevant asset if they qualify to be capitalized. Now you remember that from the first slide we said that an asset is initially recorded at the total of the purchase price, added to that any import duties or other taxes directly related to it. We'll set off any proceeds or discounts or rebates as a result of the sales transaction, and any other direct attributable costs, and then also if we have to demolish it at the end of the lifespan, we have to make an estimate of that cost as well. Okay, so let's look at the cost items that we've incurred and see where do we slot that in. Now the first cost item was option fees. We paid 3 options of $100 each on 3 separate blocks of land, and we went ahead and only bought one of those. So we'll see that for land, we'll include the option fee, but the balance, the other 2 options, we'll have to expense. The loan that we received is the liability that we raise. I'm not sure whether the loan was for the land or the building or both, but that is the liability that we raise, and the debit entry will be to cash. So it has no effect on the asset. That's the financing part of the transaction. The fee that we paid to the settlement agent for purchasing the land. The following cost item is rates that's in arrears on the building that is currently on the land when we purchase the land. And that is a cost that will form part of the cost of the land, because we have to settle those rates that are in arrear in order for the transfer of ownership to happen on the land. So even though those rates don't relate to the time when we owned the land, we need to settle it as part of the acquisition transaction. Then, of course, the acquisition cost of the land, or the purchase price. The demolition of the old building, it's part of the cost of the land, so it's to get the land in the condition that it's suitable for you. Okay, the proceeds on the sale of the material from the old building will set off against the cost of the land, because it reduces the cost of the land. And I think that's all the costs that relate to the acquisition of the land. So we'll then total that, and it should add up to 121,600, and that is the initial cost of the land. Okay, if we move down on the list of costs, we'll see that we now incur costs relating to the building, the construction of the building. So first of all, we've got architect's fees. So that is typically an example of costs that are directly attributable to the building asset. Also the council's approval for the building construction. The safety fence around the construction site. So even though it's not a permanent fixture, it's a cost that we can directly attribute to the construction of the building. Okay, the cost relating to the construction contractor, that's a straightforward one for the building. Okay, and then let's move on to the next slide. I mentioned the driveway, parking bays and safety lighting. That would be capitalized separately as improvements due to the fact that they'll have a different depreciation policy than the buildings and the equipment. The interest that we pay on the loan, we need to consider whether that qualifies to be capitalized. In general, interest is expensed in the period in which it's incurred, So it's normally recorded in the income statement. But if you look at the accounting standard on interest and financing costs, we'll see that certain assets do qualify for the interest expense used or that we incur on the financing of those assets to be capitalized. So if we look at the, we don't know exactly what the loan was used for, whether it's for all of these asset items or whether it's for only certain of them. But the only asset of these four, the land, building improvements and equipment, which technically should qualify for a capitalization of financing costs, is the building. So we might need to proportion that interest expense. So that, we need to look at the accounting statement for that. Okay, the safety inspection on the building, it's a cost that we can directly attribute to the building, getting it into the conditions that it's ready to be used. If we don't do the safety inspection, of course, we can't start with our operations inside. Okay, equipment costs will go straight to the equipment asset because that is the market transaction and the purchase price. Then any freight and insurance costs on the delivery of the equipment is also an example of a directly attributable cost. Installation costs on the equipment because we need the equipment to be installed so that we can actually use it in order to get it to the condition that it's available for usage. So that is a cost that we can directly attribute to the equipment. Safety fence around the equipment. Then the removal of the safety fence around the construction site. So that is the cost that once again relates to the building and getting that in the correct or the right or fit condition for operation. And because we then erect a new fence around the factory, so that new fence will be part of improvements. Once again, because that will have a different depreciation rate than the other asset categories. Advertising in local newspaper to advertise the new business, it's an expense, a marketing expense, and would not normally qualify to be capitalized as an asset. So it's recorded as an expense in the year or the period in which we incur that cost. Same goes for the opening ceremony, also most probably marketing costs. So we'll expense that, and it's not a cost, neither the advertising or the opening ceremony is a cost that we need to get these assets in the right location or to get it into a condition so that we can start using it. So these costs are more just to promote the business and the opening of the business. So we need to expense that in the current year. The last cost item that we had to consider is are adjustments to the equipment so that it operates at more efficient levels. That is a cost that we can directly attribute to the equipment because we've incurred it together with the setting up of the equipment, testing it, and getting it at the right level so that it operates according to the specs as required. So yes, this example I think illustrates what you first of all have to consider, and that's namely to identify the possible assets that you want to capitalize, and then to measure the costs that you've incurred against the accounting statement for PPE to see what costs actually will qualify to be capitalized as the asset, so to include in the capital base of the asset on the balance sheet. If they don't meet that definition of capital cost that can be capitalized, we need to expense it in the current financial year. I hope this clarifies the whole concept of the initial cost measurement of an asset. If you have any further questions, please feel free to post a question on my guru, and we'll get back to you with a more detailed explanation.